Stock Market for Beginners. I was talking to a young lady who works at an insurance company, and she was basically renewing my home insurance. And I wanted to explain to her how the stock market goes because she does not know. She's new to it. And, somebody in her family was like, yo, get into the stock market. So I'm going to try to sum this up the best I can and how I got into the stock market. All right. Let me turn this around for a second. Turn this around for a second because I need to go into. And yes, that's my music too. I need to go into my bank account real quick here. All right, so stock market for beginners. If you're gonna get into the stock market, here's the best thing you can do, especially while the government is giving out money. So to me, there's a few things you need to have in line. For one, you need to have a source of income. All right, you got a source of income, and that source of income is not strapping you every month. Meaning, every time you get your paycheck, it goes right out the window, and that's how you're surviving. So if you're getting, if you have enough where you can take some money and put it away into a savings account. Well, don't just put it away into a savings account because a savings account is not benefiting you once the money is in there. That savings account is more or less a pond. And just like any pond, if there's not more water going into it, eventually it'll dry up. That's what that's what a savings is doing. If you don't keep putting money in there, money's going to keep coming out. One, ATM fees. Two, the bank charges you to have an account with them, and they take money out every month. And they take money out for different reasons. Depends on what your bank account is doing. Depends on your age. Depends on if you're a veteran or not. AARP and all this other stuff. But if your bank is taken away from you, then you have to keep putting money in there. That money is not doing anything for you if it's just sitting there. Okay. So on that note, if you do have a savings account where your money is sitting there, that is basically considered your emergency fund. So I'm saying all that to say this. Let's just say if you made $5,000 a month, but you only needed two of it to survive. This is your basic bills, car bills, light bills, house, whatever it is. Your basic bills is covered with $2,000. You're covered. $3,000, you do what you want with. You go out, whatever. You do what you want with that money. You take that $3,000 and you know that just on, gas or whatever, having fun with your peoples, you're going to eat through about 1,500 of that just casually for no reason at all. You're going to eat through 1,500 of that. Okay, boom. Now you have another 1,500 that usually just sits there. So, okay, fine. So if you got $1,500, this is happening every month, and now you've accumulated, some decent dollars in there. Now you got yourself 6 months worth of savings in there. So let's just say you have $6,000 in the bank. Well, that $6,000 is what it would cost you if you lost your job. Every month you could pay your basic costs for 6 months. This is around the same time you would get another job. If you wanted to chill for a month, whatever, you're like, I think I want to get another job now. Go through interview process, yada yada. Boom, 6 months. So you have 6 months savings. I tell people, if you have 6 months savings, you're good. You also have your rainy day fund. Your rainy day fund, you don't even have to have that in the bank. You can have it in your pocket. You can have that, when I mean your pocket, I mean under your pillow, under your bed, in a piggy bank, somewhere where you can get to it immediately. Your rainy day fund is for flat tires, bailing You need bailed out of jail. You need to bail somebody out of jail. Um, just any emergency fund. So somewhere around $500 will do it. That's an emergency fund. You need it, boom. It's right there. It's cash, is accessible. You don't have to run to the bank, no nothing, boom. Something happened, bang, I'll be right there. Your emergency fund. So now you got your fixed cost savings. Now you got your emergency fund. Now let's just say that after your 6 months, you still got money coming in because you're working. Boom. Next month hit, you got another $15 that you're not 1,500. You're not doing anything else with. Say a year goes by. Now you got $12,000 in the bank. That money is still just sitting there and it's being eaten up by the bank. So you take $6,000 and you're like, you know what? I want to know what I can do with this money. So you start asking the bank what you can do with this money. They're going to give you a whole bunch of options, anywhere from a robo account to a CD to a self-directed account, which can be an IRA. It can be a regular IRA or a Roth IRA. And so they're going to give you a bunch of options that you can put, your $6,000 into. One of those options you can take, depending on the risk, is a CD. A CD is low risk. There's risk whatever you do with a bank, but a CD is low risk. It's a lot lower risk than it would be putting it into the stock market. So you're like, boom, okay, boom. Tell me about your CDs. They have CDs. Some of them are called step-up CDs. These CDs, with the certificate of deposit, a step-up CD, meaning that the percentage of the money that you're getting from the return, say you put $1,000 in there, and you get 1.5%. You get 1.5% of that in 6 months. If you keep it in longer, it's 1.6. You keep it in longer, it's 1.8. The longer you keep it in, the more the percentage goes up. They have those who are for people who only want to do it for a year and just, grab their money after a year or 6 months or 9 months. So you got step-up CDs. Then you have CDs that are for long-term. So you're like, I want a long-term CD. What's the highest percentage you got? Well, the highest percentage they have is going to be probably from 4 to 7%. Depends on who you go to. But if it's your bank, let's just say your bank had 4%. So if you had $1,000, they're going to say if you have $1,000 CD, you're going to get 4% of that. So what you're going to get is $40 off of $1,000, and then you're going to get 4% of the 40 every year. It's going to accumulate. So after 4 years, you're going to come out with $160 plus whatever the 4% accumulative was on that each year. Boom. So you have that. You're like, okay, that's cool. You might not want to put $1,000 in there. You might want to go ahead and put $4,000 in there, so you can get 40. So you can get that 4%, and then boom, bam, boom. You know how that goes. And then at the end of 4 or 5 years, you have the option of taking that money, and or if they offer the same thing again, you can go ahead and throw $10,000 into it and get the 4% off of it if they still have it, because that bank wants you to keep money and keep putting money in there so they can take that money and use it. But nonetheless, when it's all said and done, you're making 4% off of this. Now, if you had a 47-month term limit on a CD, and you wanted to take your money out, they're not going to charge you that much. They're going to penalize you, but it's not going to be that much. So if you need to take your money out of it, you can take your money out of it. You're not going to get penalized that much. So it's not money that's going away from you. It's money that you're still making, but you're making it a lot slower than you would on the stock market. Let's move over to the stock market. So let's say you wanted an account, but you don't know what you're doing because you're brand new to the stock market. Well, you can put your money in what's called a robo account. Now, depends on what bank you are, depends on what bank you belong to or wherever you want to put your money into. The robo account upfront fee can be different. So let's say if you go to US Bank. US Bank robo account is going to be somewhere around $5,000. So if you got $5,000, you want to put it in a robo. Actually, it's $10,000. It's $10,000. So if you got $10,000, you want to put it into a robo account. Boom, you put it into a robo account, which means that it's pretty much automated, but it's ran by the investment branch of that bank. So those are the people who are putting your money into investments. you're also going to have a checking account so they can sweep from that account, which means they can take money from that account, and or you can add money to your robo account from your checking or your savings account. So let's just say that once again it's $10,000 and your account it's on the stock market, so so let me show you this a robo account so I can illustrate this clearly. This is a robo account. All right, so I don't have too much on it. Turn this up a little bit. I got $284 on this robo account. I took the majority of money out of it because it didn't make money fast for me. This is what the stock market did today. I lost 10 cents today. This is how much I've gained since this robo account's inception, which is almost 2 months. That's how much I got off of this robo account. So I've only got $3.22. Like I said, this is my principal here. This is what I made today or lost today. This is what I made since I've been here. It allows you to transfer funds, which you can bring funds into your account now. Bring funds into this account. How would I do it? I go to my accounts. I go to my checking account, which is here. Boom. And I would go over here to transfer money, which is here. And then it would say, it's asking me pretty much where I want to transfer money to. So it's taking my checking. This is my checking account. And this is where I'm transferring money to. My self-directed or my automated account. This is my automated account. Then you put the amount of money that you want to transfer in there. So let's just say I wanted to put $100 in there. I put $100 in there. Boom. It would transfer it in there within a day or two. All right. So that's how you transfer money in and out of your automated account. All right. And know this, your automated account it's not money that you can't go in there and manipulate. All right. You just can't fall under the principle. Now, the reason why I have a robo account with Chase is because the robo account with Chase, to get into it was only $250. So I just wanted to see how it works, and basically it's a set it and forget it. You don't know what you're doing in the stock market. This is one of the ways that you can get into the stock market. Remember, it's not a deposit, so you can lose 20 to 30, 40% of this money that you put in there. All right? So know that. All right? So once again, automated account, something just changed? Okay, boom. I gained 20. Okay, so it's finishing up. The stock market opens at 9:30 and it closes at 4 o'clock during the week. Okay, they do not work on weekends. All right, so sometimes you're still getting money that's still coming in, and that's what happened here. I actually made 10 cents off of this account. Now, if you want to know what it plays, this is what it plays. This is where your money comes from. These are all the stocks that my robo account is invested in. There's a breakdown of it right there and what it's doing. And who made money and who didn't. That's my robo account. So you have the Dow, NASDAQ, the S&P. The S&P was up today. The New York Stock Exchange and the Amex. So there they are right there. So if you don't know what you're doing, you can get a robo account. I'm saying that because once you dive into this, you could lose money very quickly. All right. And I'll get into that too. But if you want to step out, on chance, but you got cold feet, throw it into a robo account and let them do it. Now, the people who are dealing with Chase, of course, is Morgan Stanley. Those are the people who are, doing these investments, and they're looking at this every day. It's kind of like your 401k. You know what I'm saying? That's what they do. Your 401k goes right into these markets here, these 5 markets that I've read off to you. All right, so now let's just say that let's just say that you want to step out on chance, and you're like, okay, I want to step out on chance. Once again, this is a checking account. So I throw money into this checking account and then I feed these two accounts. All right. So this is my self-directed account, which means I'm the one that manipulates this account. So if it loses because of me. But it's still playing the stock market. But here's the thing about this account. If I just, and this is an IRA, this is a Roth IRA. If I just wanted to put money into this account and let it sit there, that's exactly what it will do. It won't touch the stock market unless I start trading. So let's go ahead and look at it. This is how much money is in there. This is how much money I made. This is how much, excuse me, this is how much money I made today, $13. This is how much money I've made since inception for the last couple months, 192. This is the annual estimate income, even though that's going to go up because I'm already past that. But you can lose on the market tomorrow, so this can drop down $25, $30 very easily. This is what the money's invested in. Shows you all where your investments are at. These are where your investments come from, or the Nasdaq. Or I'm sorry. This is the Nasdaq, the S&P, the Amex, the New York Stock Exchange. And these are all of what I chose to invest in. So this is my DCP, which is midstream. I have a REIT in here. I have a VOO, which is a Vanguard ETF, and so on and so forth. But I put a lot of money into this DCP because that DCP pays me pretty much every day. Every day that DCP pays me, and as you can see here, it's just constantly going up. I think it's gone down once, and that was my DCP dropped to $25 2 days ago, and then it jumped right back up. Now, some of this is me putting money into it. So when it's going straight up like that, that's me putting money into it. I drop more money and more money into it. When it goes to the side like that, and up like this is me making money off of the stock market. That's what that is. I'm making money off of the stock market. So for some of you people think you can't make money off the stock market because you're a little skittish, cut that out. If I can make money off the stock market, you can make money off the stock market. And that's exactly what's happening. But okay, so this is an IRA. So you have limits to your IRA depending on your age and your income, so on and so forth. My limit is $7,000. So you can have more than one IRA also. So I can fill this whole thing up this year, and then it'll stop me, and then I can go ahead and get another IRA. So I can put $7,000 in it, boom, it'll stop me. But I make money off of this every single day. I either make a little or lose a little, but I either make a lot or lose a little. I've only had two major losses on here. One was for $30, one was for $35, and the other for $25. But you can see that I am making money, all right, on the stock market. So there that is. So if you guys need to know any more, go to YouTube, type in how to play the stock market. Also, I use Cash App. So that's how you can lose money. Like yesterday, I was using GameStop, which is a meme stock. A meme stock is very volatile. It's kind of like Bitcoin. And what happened, basically, it went up. I had almost $2,000 on it. I traded twice on it. I couldn't trade anymore and did not know that. And then it dropped 27%. I wasn't able to pull out while it was in its tailspin. And the next day, it jumped up to 4%. So automatically, look, I lost $489 yesterday, and automatically when I woke up, or when the stock market opened, it had jumped all the way to 4% instantly. And I made like $148 instantly. It went back down again, but it recovered. So I did okay again with GameStop today. So that was very scary. You can only trade twice with one stock on Cash App, I did not know that. And that was a very valuable lesson because I could have lost a lot of money, but I did not lose that money. Uh, so if you're going to be on Cash App and you're going to get in the meme stocks like Macy's, AMC, things along that line, be very, very careful. Keep your eye on that stock because if that stock drops, you're going to lose a lot of money very quickly. So just be very careful. If you're not somebody who can watch your stock all day, keep an eye on it. I would not play with those meme stocks whatsoever. I would have somebody who knows something about it do it. And that's just me. That's just the way I would do it. Other than that, you can get other stocks that are going to sustain you. You can get yourself some dividend stocks. There are a lot of dividend stocks out there. One of my dividend stocks is an Larry fund. My Larry fund is dope. I love it. It's called an Alarian fund. I've only lost on it once, and it's been making me money ever since. And I put a decent amount of money into that Alarian fund. I got I got $800 into it. I made almost $100 off of it. So yeah, and that's just that one stock. I've made almost 100 off of it since I've been in it. The reason why I like it is because it pays 8% dividends. So yeah, I'm gonna put a lot more money into it because that dividend really helps if you're losing money. Plus it's going up. So I made like $87 off of it. Plus it sends me 8%. My first check was $14. I have a dividend for $14 off of it. I mean, you just can't, it's just hard to beat that. So I really like that fund. They don't have, any company that pays dividends doesn't have to pay you dividends, especially if it's a REIT. REITs deal with, they deal with real estate. Real estate has to pay out 90%. But other companies like McDonald's, they pay dividends. I got a dividend from GM today. It was only for 59 cents, but I only have $50 in it. So yeah, so if you're into dividend stocks, those are just, I mean, you can look up dividend stocks and see which ones pay the best. If you want to invest in them, but be careful because they may be paying a lot because they're, something's wrong. So don't always just go for the ones that are just paying the most. But my Alarian fund is not just one stock. It's stocks and bonds. So yeah. There are loaded funds and there are non-loaded funds. So if you're going to, try to get into some funds, you got to be careful because if you get into a Vanguard fund is not going to charge you up front, but they're going to charge you on the back end. So I do have a Vanguard fund, but it's an ETF, which is an exchange trade fund. So I have one of those. And also my Alarian fund is an exchange trade fund. But my Vanguard fund does not make nearly enough money. I'll read that in a second. My Vanguard doesn't make anywhere close to what my other ETF makes. My Alarian fund is making your boy some dough. I put it to you like this. I used to work at a temporary service and I made $51 a day. I make that now doing this. Easy. Okay. Is cryptocurrency? Yes. The answer is yes, 100%. Cryptocurrency is probably the fastest way to come up. Cryptocurrency and meme stocks, fast. But crypto is more volatile than anything. I mean, it is an active volcano. So so let me see if I can pull this up. Go ahead and log into my eToro account. This is eToro. These are all cryptocurrencies. You can add more to it. This is my watch list. Lets me know what's going on, who's doing what. This is a very volatile system that I only have 20 bucks into. Simply because when it comes to these cryptocurrencies, somebody has the wallet for these cryptocurrencies. And the reason why they fall so fast is because those 20 investors who has the wallet for the majority of these currencies are going to take money from you. This is why a lot of people are losing a lot of money, because these investors, they're just going to snatch money from you. It's kind of like what happened with Robinhood. So this is why I don't deal with Robinhood. So you got to be careful. And like I said, I have about 20 bucks. I used to be a Dogecoin guy. There's your Doji right there. I don't really deal with Doge anymore, but you can tell if it's going up and down. I have, like I said, I have only 20 bucks in Bitcoin. I don't see Bitcoin on here. Oh, here it is. Bitcoin has been going up, so it's at 37. The other day it was at 34. So there's a Bitcoin right there. It's at 37. And like I said, I only have 25 bucks on it, or 20 bucks on it. And it's just kind of sitting still. It's not really going anywhere. But I'm keeping my eye on it. Another thing, Bitcoin does not have an off switch. So let's just say you put $500 on Bitcoin, right? Okay, let's just say at the end of the night, say it's 11 o'clock at night, you're going to hit the sack. You got 500 bucks on Bitcoin. You're looking at your tickers. It's going up. You're like, yeah, Bitcoin's going up. I'm going to sleep. You fall asleep. When you wake up, you lost yourself $7,000. How? Because Bitcoin sank. This is what happened to a bunch of people, and some people, couldn't handle it. You had people losing like $25,000 in an instant because they couldn't get out. They didn't even know it was happening. Woke up and their money was gone. So be very, 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 very careful of Bitcoin. All right? All right, you guys, that's it for me. If you got any questions, let me know. Peace.